So I'm the first one to go, so thank you very much, Olivia, for organizing such a great event and giving us the opportunity, Robert and myself, the opportunity to discuss about capital market risk for retirement. So as you're going to see, I'm going to take the opportunity, since I'm the first one, to give an overview about liability-driven investment, and hence you're going to see a little bit market risk, but blended together with the other types of risks. Then the idea is to give you a flavor, some risk innovations, and then conclude with some challenges and opportunities ahead in the, within the limits of my 12 minutes. Okay, LDI overview. Let me start with a nice picture representing a pretty rosy situation when you have essentially pension plan, substantial level of assets well above the liabilities, the red bar, and at this point you'll be able essentially to do surplus management, right? And linking the two bars there, an ALM strategy, an asset liability management strategy, could actually allow you to comfortably meet the liabilities as they fall due. But then what happened in practice traditionally is that people tended to use a spread-based approach, return-based approach. So you can't see the line anymore there, but you typically weaken essentially the liability and assets, and we focus instead on investment benchmark, allowing you essentially to get a reasonable expected return, well, certainly higher essentially than the rate at which you were expecting your liabilities essentially to evolve over time. And you were, of course, trying to pick investment opportunities with interesting risk-return characteristics, and but as you know, moments, first, second, third, and fourth moments are averages at the end of the day, and then all of a sudden, everyone might have experienced essentially with this particular approach, with a weak link between liabilities and assets, a drawdown. You end up in a situation where essentially you are underfunded. You may decide to inject cash, but perhaps there's better use for your cash there. You may see the situation as a sort of a cheap way of borrowing, right? You have leverage, we have all sorts of risk-taking incentives, and so on. Even worse is if all of a sudden you realize that actually liabilities are now what you thought it was the original red bar, right? For example, all of a sudden you need to use some more updated mortality tables. You need to take into account the term structure of interest rates. You're not allowed to discount future cash flows with generous risk premium, essentially. So that's essentially changed in use, at least in the last slightly more than 10 years, a change in paradigm where essentially you refocus the asset allocation towards the liabilities. And the way we see it is essentially what becomes really important is to define a liability benchmark. Okay? Liability benchmark, in the simplest possible case, you think of hedgeable risks, the standard market risks that are tradable. You think of a replicating portfolio. But of course, the situation is much more complicated, right? Because you have all sorts of unspent sources of risk or partially hedgeable sources of risk affecting pension liabilities. Think, for example, longevity, inflation, long-run interest rates, and so on. So at the end, you need to constructing the liability benchmark and then valuing it. It becomes a kind of an interesting exercise, right? Where you have to take a holistic view, essentially, of the risks you are facing, right? Because it may not pay actually to bucket up, to classify according to the usual paradigm the different sources of risk. You may actually take into account essentially cross correlations, the way different hedging instruments, for example, co-vary with each other. Let me give you an idea. So I flesh out a few issues when you actually want to set up this particular liability benchmark. So here is a survey well before the crisis of European pension plans, essentially. What's the average duration of the liabilities? Well, you see the distribution here. Liabilities can have a pretty long duration, but the average was 21 years in this particular case. Look at the fixed income component of the asset side, and the average duration was 8 years. So we're talking about a duration gap of 13 years. So there is no naive immunization, duration matching you can do here, okay? And this is the first, so if you want to close the gap, shorten the gap in the duration, then of course you may access some very liquid markets that are out there. There are a number of risk-sharing opportunities, for example, swaps, forward-starting swaps, swap options, and so on, right? And since you know you are dealing with inflation as well, why not inflation derivatives? It's a very liquid market, one of the most boring classes for every quant you talk to in Wall Street or in London. So it's great. This actually, there is demand to close the gap, and there are opportunities out there. At the same time, since we are talking about duration, right? So we are talking about, these future liabilities. So we need to take into account also the expected number of pensioners, right? We expect to deal with. So of course, the survival rates act as a multiplier, right, for whatever cash flows you're looking at. So you're talking about a random notional and so on, a quantum component, you may call it, depending if you want to, whether you want to use the language of derivatives. And as you can see from these pictures, it's not entirely trivial, right, to do. So this is, for example, this is a mortality. I borrowed this picture from a paper of Andrew Haynes, sitting there, and we'll speak later. So as you can see from here, mortality projections for reasonable pensionable ages, huge uncertainty depending on which models you use for life matches. So as you can understand, we talked about duration, closing the duration gap in fixed income derivatives, inflation derivatives, but we know essentially that the duration is going to be affected by longevity. This is the sort of uncertainty we are facing, right? So it is clear, when we construct the liability benchmark, it will pay actually to look in a more holistic way at all these risks together. So it's very difficult to essentially strip out interest rate risk and pure market risk from other sources of risk. Again, there are opportunities out there. There is a market, an emerging market in pension buyouts. You can see, for example, a picture. I mean, this is mainly the UK, but you have trades taking place in the other continental European countries, in North America, finally. And you see towards the end there, those yellow bars up there, on top of the standard buyout transaction, buyouts or buy-ins, you're going to find longevity swaps. So actually, part of the risks that I mentioned before, so longevity, for example, are essentially become tradable or partially spanned by some of these bespoke or indexed solutions. Okay? So this is more or less the picture. Then, of course, how about recent innovations? Because, of course, the crisis must have taught something, right? So, and not just, some people may felt like they missed out, right? Given the bond bubble and so on. Now, like LDI may look actually a little bit expensive, but at the same time, the crisis has spurred a number of innovations. Just two things I'd like to mention. One is, I think there is greater awareness about cross-asset correlation and the opportunities it can provide. Here's a picture. If you're interested, you can look at the paper. We have some data about stock-bond correlation swap. This is a correlation between S&P 500 returns and the constant maturity swap, 10-year constant maturity swap yields, right? So you see rising correlation induced by, you find the same thing in the forex, foreign exchange market, across commodities, and so on. So is this a threat, this risk-on, risk-off trading style? Well, not necessarily, because there are out there opportunities actually to get cheaper tail hedges, for example, exactly exploiting these sort of correlations, right? So you have an increasing awareness about opportunities provided by so-called hybrid products, so essentially hedges with payoffs that depends on multiple asset classes, right? A typical example, if you're a pension plan, you typically be net long stocks, net short bonds, because liabilities are bond-like, and so you may find it convenient essentially to get some protection about flight to quality, flight to safety events, so bond markets tank, bond market go up and the yield goes down, right, through a correlation swap. Vice versa, if you're worried about the bond bubble, you may find actually one of these instruments are helping you kind of hedge in case exactly the opposite happens, right? People moving away from bonds and into equity. I mean, it's great. Okay, so here, some quotes. These instruments. We did some work with some with an investment bank on this, and all this innovation was spurred by the LDI demand, essentially some pension funds. Finally, through a picture, I don't know how much it takes, but another thing that's become extremely relevant after the financial crisis is counterparty risk. What happens now is that in LDI strategies, collateral management. So essentially, as I mentioned, they are very, very typically heavily invested in over-the-counter derivatives. But now, the credit support annex, the so-called CSA, specifying the counterparty risk mitigation tools available within the instrument, are going to be increasingly relevant, right? So it's very difficult to understand the price of an instrument if you don't understand the CSA, right? Because that's going to specify essentially what's going to happen depending on whether the credit quality of the counterparty deteriorates or not. And of course, protection against counterparty risk is costly, right? Whenever you need to wire over collateral, you are essentially, transferring resources which you could deploy somewhere else, right? And so there is a funding cost associated with that. And just to give you an example, a picture where you have essentially two counterparties, a hedger, a hedge supplier, longevity swap transaction, and basically as a benchmark, this kind of projection associated with the Lee Carter model. This black line here, the straight line would be a zero risk premium, and then depending on the different credit quality of the counterparties and the specific CSA, so who has to pay collateral, is it full collateral, partial collateral, you're going to find completely different risk premium. So positive on the upper side, so essentially the swap rate embeds greater mortality improvements than the underlying model. Down there instead, you're going to find a discount. Right? So negative risk premium in the swap rate. Now, to conclude, just a few challenges and opportunities ahead, at least in our experience, that are kind of interesting and not entirely well explored. I think, so pension risk, I think, there is greater awareness among sponsor trustees about the importance, the relevance of pension risk. There is much more transparency induced by accounting standards, for example, IAS 19 and so on. The biomarker, for example, in some countries like the UK, has been extremely important to signal essentially the cost, so the value actually of, so the cost of pension risk. So, I think on the hedges, so on the pension plan side, you see quite a lot of work in terms of understanding the importance of monitoring mortality experience, doing data cleansing exercises, because immediately they translate into a huge discount in terms of the buyout quotes you can get. Then, perhaps later, the next speaker is going to talk about the interest rate environment, issues related about inflation and the bond market. Delegated asset management, I think it's going to be very important to understand the risk-taking incentives induced by LDI strategy. I think it's not entirely clear there how to properly trade off a short-term performance measure versus liability proxies that are really very slow-moving, right? And finally, what I'm really interested in is the change in regulation. So perhaps the most important things are, so if we look at the biomarker, for example, or LDI more generally, is pension regulation, accounting standards. They're going to push, presumably, provide a big push on the demand side, right, for some of these solutions, refocus essentially asset allocation towards liabilities. At the same time, when you think of insurers, so that actually are part of the hedge suppliers, for example, in the longevity swap space, well, a solvency issue, for example, in Europe, may make actually a longevity insurance pretty capital intensive, right? That might actually, create some issues there. Finally, more general, since we mentioned these over-the-counter derivatives and so on, as you can imagine, Dodd-Frank here and EMIR in Europe can have quite important implications. So, just to give you an idea, so you hear a lot of discussion about centralized clearing. But how about non-clear derivatives? So non-clear derivatives like inflation swap, longevity swap, and so on, after centralized clearing takes place, are going to be essentially, we're going to still be left with 50% of the outstanding notional, 170-something trillion euros. So pretty substantial amount of exposures out there. What is EMIR saying, for example, about pension plans? Well, they're going to be treated as financial counterparts, as covered entities. What does it mean? That means that instead of negotiating a CSA, a credit support annex, between counterparties, optimally, given the specific needs of the counterparties, the transaction we are talking about, there's going to be some more standardization. What does it mean, the standardization? We're going to have two-way segregated initial margins. So both will have to post essentially an initial margin that's going to stay with a custodian, and then they're going to be forced to exchange variation margins that are not that flexible. It's going to be full collateralization, in the sense 100% of mark-to-model or mark-to-market, okay? So in this scenario, scarcity of collateral, the collateral management process becomes a little bit of an issue, right? So, for example, yesterday, there was Martin Clark from the Pension Protection Fund in the UK, and they are, of course, in their LDI, on the LDI side, they heavily rely on unfunded trades, right? And so if everything like this takes place over the, is going to phase out over the 2015 to 2019, presumably, well, that can have a huge impacts in terms of utilization of derivatives and so. We ran some studies. I don't have the time to show you here. But bottom line, this is going to be added to the paper. Essentially, the general, so if you read, for example, about the Bank of International Settlements, the IMF or the Bank of England, what they are saying, there's a lot of focus on initial margins, the role of initial margin. Well, actually, what we find in a couple of studies we ran is that the variation margin plays a major role. It's not a zero-sum game, right? So actually using relying on an optimally designed CSA can provide huge gains for trade, essentially. And imposing mandated suboptimal collateral rules can have a pretty strong impact. Thank you very much to the chair.
Thank you.